Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Carrier Global is a leading HVAC and building solutions company. The Carrier brand dates to 1902, when Willis Carrier invented mechanical air conditioning, making it one of the oldest names in industrial history.
Carrier spent decades inside United Technologies alongside Pratt & Whitney engines and Otis elevators. In 2020, UTC spun all three businesses as independent public companies, and Carrier launched as a standalone enterprise.
Revenue splits across three segments. HVAC generates about 67% of the total, fire and security contributes 19%, and refrigeration adds 14%. Viessmann Climate Solutions expanded the HVAC segment significantly in Europe.
The Viessmann acquisition deserves focus. At 12 billion euros, it was Carrier's largest deal as an independent company. Viessmann is the leading European residential heat pump brand, precisely as EU electrification mandates push households away from gas heating.
Carrier's moat rests on three pillars. The 120-year-old brand drives contractor specification preferences. The aftermarket network generates recurring revenue from the installed base. And Viessmann's heat pump leadership is hard to replicate.
About 35% of revenue comes from aftermarket parts, service, and maintenance contracts, higher margin than equipment sales, and resilient when commercial construction activity slows.
Operating margins run around 14%, and organic revenue growth tracks near 8% annually. CEO David Gitlin is managing the Viessmann integration while divesting lower-priority fire and security assets to sharpen the portfolio.
David Gitlin led the HVAC division inside United Technologies before becoming Carrier's first CEO in 2020. He architected the spin-off strategy and the Viessmann acquisition, leading the company since its first day as a public entity.
The data center cooling opportunity also applies to Carrier. As hyperscale computing infrastructure expands, precision commercial cooling demand grows, and Carrier's HVAC portfolio is positioned to capture a share of that wave.
On the competitive side, Carrier's primary rival in HVAC is Trane Technologies, with Johnson Controls and Lennox International also competing across various market segments. In heat pumps, European brands Daikin and Bosch are Viessmann's primary competitors.
The dividend has increased every year since the 2020 spin-off. The yield is modest, but the growth trajectory has been consistent. The company returned approximately $440 million to shareholders through dividends in the last fiscal year.
Carrier operates across over 160 countries, with more than 100 manufacturing and engineering facilities. The Viessmann network adds extensive European distribution and service infrastructure, significantly deepening the geographic footprint.
The long-term tailwinds are compelling. Energy efficiency retrofits in aging buildings, residential heat pump adoption in Europe, and data center cooling demand all favor Carrier's product portfolio over the next decade.
From inventor of air conditioning to a modern platform spanning heat pumps, commercial HVAC, and building safety systems, Carrier has reinvented itself while maintaining the brand trust built over generations.
That's the company chapter for Carrier Global. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Carrier Global just delivered a Q1 2026 beat that put the data center cooling thesis front and center. Revenue $5.34 billion, up 2.4% year over year. Adjusted EPS 57 cents versus the Street's 51, an 11.8% beat. Commercial HVAC orders surging on hyperscaler demand. The pure-play HVAC story is finally clicking. This is Charged Alpha. Let's break it down.
Carrier Global is a pure-play heating, ventilation, air conditioning, and refrigeration company spun out of United Technologies in 2020. The transformation under CEO David Gitlin has been dramatic. They sold the fire and security business to Honeywell, divested industrial fire, and used the proceeds to acquire Viessmann Climate Solutions, the European residential HVAC and heat pump leader. Today, the portfolio is Climate Solutions. End of story.
The two big growth vectors are data center cooling and European heat pumps. Carrier's Quantum Leap Thermal Management Suite and the new Aqua Edge 30CF chiller are landing applied orders from hyperscalers at a record pace. Management is guiding to $1.5 billion in data center revenue this year. On the residential side, Viessmann gives them direct exposure to European energy transition spending.
Let's walk Q1. Total revenue came in at $5.34 billion, up 2.4% from $5.22 billion in Q1 2025. Organic sales rose roughly 5%, driven by commercial HVAC strength and a 38% jump in container, partially offset by global truck and trailer down high single digits. Adjusted EPS 57 cents beat the 51 consensus by 11.8%. The top line beat by over $300 million.
Margins tell a more nuanced story. Adjusted EPS of 57 cents was actually down 12% year over year. GAAP operating profit fell 59% to $259 million, and GAAP EPS from continuing operations dropped 40% to 28 cents. The compression is concentrated in the climate solutions segments. Residential softness and integration costs from Viessmann are still working through the income statement.
Trailing 12-month free cash flow stands at $2.09 billion. Operating cash flow for the quarter was just over $1 billion. Cash on hand $1.55 billion against $12.67 billion in total debt. Net debt of $11.11 billion. That debt load is the legacy of the Viessmann acquisition closed in 2023, and it is the single biggest item the bear thesis hangs on.
Total equity on the balance sheet is $14.13 billion. Gross margin 25.9%, operating margin 9.9%, net margin 6.9%, return on equity 14.2%. These are decent industrial products numbers, but well below where bulls expect Carrier to trend once Viessmann synergies fully land and the residential cycle turns.
Capital allocation is the swing factor. Management guided full-year free cash flow to roughly $2 billion. Most of that is earmarked for debt reduction. Carrier wants to take net leverage back below 2 times EBITDA over the next 18 months. The dividend yield is 1.4%, and buybacks have been modest while the balance sheet repairs.
Full-year 2026 guidance was reaffirmed. Roughly $22 billion in revenue, $3.4 billion in adjusted operating profit, $2.80 in adjusted EPS, and $2 billion in free cash flow. That guide implies low single-digit organic growth with margin recovery in the back half as climate solutions normalizes and data center orders convert to revenue.
Analyst coverage skews positive. 6 buy ratings, 3 holds, 0 sells. The average price target sits at $70.93. With the stock around $61.46, that implies roughly 15% upside to consensus. A meaningful gap that reflects analyst confidence the data center thesis plays out and climate solutions margins recover.
Valuation runs around 22.1 times forward earnings on the 280 estimate. Price to sales 2.36. Enterprise value to EBITDA roughly 16.8. Price to book 3.6. Carrier trades at a modest discount to Trane Technologies, in line with Johnson Controls, and a discount to Lennox, reflecting the higher debt load and the residential exposure that peers don't carry as heavily.
Bullish analysts emphasize the data center order book. Q4 commercial HVAC orders in the Americas were up 4 times year over year. Applied orders more than tripled. Management is guiding to $1.5 billion in data center revenue this year, up from $1 billion in 2025. If hyperscaler CapEx stays at the projected $593 billion in 2026, that segment alone could grow above 30% annually.
The cautious camp focuses on residential. Higher for longer mortgage rates have pushed U.S. housing transactions down, which directly hits replacement HVAC demand. European residential heat pump installs slowed after governments dialed back subsidies. If those two cycles don't turn in the back half, the full-year guide gets harder to defend, and the debt paydown runway extends.
Beta is 1.32. Carrier moves more than the market, especially around housing and rate-sensitive prints. The stock is up roughly 14% year-to-date heading into earnings, so a fair amount of the data center optimism is already in the price. The next leg requires the FCF guide to land and net leverage to keep coming down.
The bull case rests on three pillars. First, data center cooling is a generational tailwind. Hyperscaler capex projected at $593 billion in 2026 is 45% higher than last year. Carrier's applied chiller and liquid cooling lineup has the right product mix and the relationships to scale that revenue line for years.
Second, European heat pump adoption. Viessmann gives Carrier the leading premium brand in Germany, the largest heat pump market in Europe. Once subsidy programs stabilize and energy security spending resumes, this business has a multi-year runway tied to the European Union's electrification mandates and building decarbonization rules.
Third, debt paydown unlocks value. $2 billion in free cash flow against $12.7 billion in debt means Carrier can retire $2 to $3 billion of debt over the next 18 months. Every billion of debt reduction lowers interest expense and lifts EPS, a mechanical earnings tailwind independent of revenue growth.
The bear case starts with the GAAP numbers. GAAP operating profit fell 59% year over year. GAAP EPS from continuing operations dropped 40% to 28 cents. The adjusted figures look fine, but the gap between adjusted and GAAP heat has widened, and that's a quality of earnings warning bulls tend to dismiss too quickly.
Residential HVAC is the second concern. Mortgage rates above 7% have suppressed housing transactions, and replacement HVAC demand correlates closely with home turnover. If the housing cycle stays frozen through 2026, organic growth in the largest segment of the company stays in the low single digits at best, with margin pressure from underutilization.
Viessmann integration is the third risk. The acquisition closed in early 2024. Synergy targets remain on track per management, but cultural integration of a German family-owned business into a U.S.-listed industrial is rarely smooth. Any integration miss compounds with the debt overhang and forces management to choose between paydown and growth investment.
Fourth, the debt itself. $12.7 billion in total debt with net leverage above 2.5 times EBITDA is meaningfully above peer averages. If free cash flow falls short of the $2 billion guide, say through a residential airside downturn, the paydown timeline slips, the credit story weakens, and the equity multiple compresses with it.
The HVAC peer set is concentrated. Trane Technologies, ticker TT, is the cleanest direct comp, pure-play HVAC with a strong commercial mix and applied product leadership. Trane trades at roughly 28 times forward earnings, a meaningful premium to Carrier's 22 times. The market is paying up for Trane's lower debt and consistent margin profile.
Johnson Controls, ticker JCI, is broader. Building products, fire security, and HVAC under one roof. JCI trades around 19 to 20 times forward earnings, a slight discount to Carrier. The conglomerate structure has weighed on the multiple, even as their commercial HVAC business posts similar data center exposure.
Lennox International, ticker LIE, is the residential pure play and the highest multiple name in the group, roughly 25 times forward earnings. Lennox has no European exposure, no data center applied business at scale, but they have the cleanest balance sheet and the highest gross margins. They're effectively the premium way to play U.S. residential HVAC.
Versus the group, Carrier is the highest debt name with the highest growth optionality on data centers in Europe. The trade is a bet on execution. If Viessmann synergies land and net leverage drops below 2 times by 2027, Carrier deserves to close the gap to Trane. If not, JCI's multiple is the more honest comp.
Options activity has tilted bullish since the Q1 print. Put-to-call ratio at 0.78 reflects above-average call demand. June and September call open interest concentrates at the 65 and 70 strikes, exactly where the analyst price target cluster sits. Premium sellers have been active fading the post-earnings volatility crush, a typical pattern after a clean beat.
On the put side, hedging activity at 55 and 50 has been steady. That's about 10 to 15% below current price. Protection against a residential disappointment or a broader industrial sell-off. The skew tells you institutional holders are long but not complacent on the housing rate dynamic.
Insider activity is quiet. CEO David Gitlin and CFO Patrick Goris have been selling on pre-scheduled 10b5-1 plans, standard practice. There has been no unusual insider buying, but also no concentrated selling. Net-net, the signal is neutral. Management's compensation is heavily tied to total shareholder return targets, so incentive alignment with the debt paydown thesis is solid.
Institutional ownership runs around 92% of float. Vanguard, BlackRock, and State Street as the top 3 holders. That's a heavily indexed holder base, which means flows follow earnings momentum rather than fundamental conviction. The active manager position has grown modestly, suggesting fundamental buyers are starting to lean in on the data center thesis.
Bottom line on Carrier, a clean Q1 beat, a credible data center story, and debt paydown that mechanically lifts EPS. Adjusted earnings still down 12% says the cycle hasn't fully turned.
If you own it, ride the data center ramp and watch net leverage. New buyers should size for the volatility. Charged Alpha rates this a constructive watch. The thesis is tracking, but margin recovery has to show up in Q2.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.